Hello, my friends. Today is May 20th. My name is Joseph, and this is Markets Weekly. This week, we're going to talk about three things. First, we're going to talk about the debt ceiling, which has been in the news the entire week. I'll tell you why I don't worry about the debt ceiling at all. Secondly, I'm going to talk about what I wrote about recently, that is the possibility that the level of liquidity in the banking sector drops below cautionary levels faster than many expect, and what the Fed might do about it. And lastly, we'll go over some of the Fed speak that happened this week, and we had a lot of Fed speak, including Chair Powell himself. Okay, now, beginning with the debt ceiling. As many of you know, the US government always spends more than it receives in taxes. That means in order for the government to continue to function, it has to keep issuing debt. Now, this wasn't always the case. There were periods in our history where we had a balanced budget and sometimes even budget surpluses. But over the past few years, that's really changed. We have very large budget deficits right now and for the past few years as well. Once upon a time, some politicians were really concerned about the prospect of large deficits. They looked around the world and across history, and they noticed that countries who run huge budget deficits eventually end up with high inflation, high interest rates, and very poor economic growth. So they created the debt ceiling. What the debt ceiling is that it limits the ability of the US government to issue debt. It cannot issue more debt than set by the debt ceiling. When the government hits the debt ceiling, Congress has to decide to lift it. And so there's a negotiation and process, and the debt ceiling gives certain political parties some negotiating leverage to reduce federal spending. So we're at this moment right now where we've already hit the debt ceiling in January, and the government may potentially run out of headroom, maybe in June, maybe in July, maybe in August. It's really hard to know. We have a lot of headlines this week saying that there was optimism and then pessimism, so forth. Historically, over the past several years, we've seen this play out over and over again, where there's always fear, there's always uncertainty, and then at the last moment, there's a compromise, the debt ceiling's lifted, and we all go back to business as usual. So market participants are rightly skeptical of this being a major market moving event. And if you're a professional investor, you basically don't worry about this at all because you already know that there's lots of things both the Fed and the Treasury can do to make the debt ceiling a non-issue when it comes to markets. The biggest fear of a debt ceiling would be a default. That is to say, the US government runs out of money and is unable to pay interest payments or principal payments on its debt. If that were to happen, there would be tremendous amounts of uncertainty. For example, what would happen to all the investors who are counting on coupon interest rate payments? Can they hold defaulted treasuries? Or let's look at the repo market. What if you were lending against a treasury that defaulted? Would you still be willing to hold that as collateral? There's a lot of uncertainty about how this would play out. But we also know, though, that the Fed would not let this happen. The Fed has a mandate for financial stability, and through congressional subpoenas, we also found out that the Fed actually has a backup plan in case there really was an actual default. What the Fed would do is that they would undertake payment prioritization. So the Fed is the Treasury's banker. If the Treasury were ever to default, what the Fed could do is to prioritize payments towards interest payments and principal payments on US Treasury debt and default on other people, like military contractors or Medicare recipients and so forth. There is enough money coming in from tax receipts to basically pay interest on the Treasury debt indefinitely. So once payment prioritization kicks in, there would be no default on the Treasury securities, but there would be some impact on the real economy because vendors or whoever the federal government pays money to will not be receiving payments in a timely way. Even if the Fed were to not undertake payment prioritization, there are still many tricks that the Treasury can do to make sure that they don't default on the debt. They're doing one of the tricks right now. It's called extraordinary measures. What extraordinary measures really is, in a nutshell, is changing the composition of Treasury debt away from debt that counts towards the debt limit and towards debt that does not count towards the debt limit. For example, the US government has a lot of retirement accounts for, let's say, the Social Security recipients or for government workers that invest in Treasury securities. Part of the extraordinary measures that are being undertaken right now is that the US government is asking those trust funds to not invest in Treasury debt. And if they're not investing in Treasury debt, there's less debt that counts towards the ceiling. Instead, the US government is just telling those trust funds that, we'll pay you back later after this is all done. So in a sense, instead of getting a Treasury security as an IOU, they're getting another kind of IOU that doesn't count towards the debt ceiling. There's a lot of little tricks like that to make sure that the Treasury doesn't default on Treasury securities. So there's not going to be any huge default. That's totally out of the picture. But what you should be worried about, though, is what it takes to get a debt ceiling compromise. Usually, it takes some degree of spending cuts. If the federal government were to reduce its spending, obviously that's less demand in the economy, and that will slow economic growth and potentially push us towards a recession. That being said, of course, we are already spending a lot of money, so some restraint is not unexpected and wouldn't be unhealthy in the medium term. So what we should be focusing on is just what kind of compromise it takes to get a debt ceiling lifted. Okay, now the next topic we'll talk about is my latest piece, Probing LCLoR, where LCLoR means lowest comfortable level of reserves. So from the Fed's perspective, the banking sector needs a certain minimum level of reserves to function. Reserves are just cash held at the Fed. So if you're a bank, you hold, of course, banks have cash. So if you or me, if we have cash, we hold it in a bank as a deposit at the bank. If you're a bank, though, you hold your cash as a deposit at the Fed, and it's called reserves. From the Fed's perspective, if the amount of reserves in the banking system drops too low, then you could have some hiccups in the financial system. The Fed looked at the repo spike in September of 2019 and perceived that to be the banking system not having enough reserves. And based on that, there are estimates from the New York Fed where the banking system needs about, the amount of reserves the banking system needs is about 8% of GDP. Today, that's about 2.2 trillion. Reserves right now are 3.2 trillion. So based on this estimate of 2.2 trillion minimum, there's about 1 trillion in excess reserves in the banking system. But there are two things in the coming months that will drain that 3.2 trillion very rapidly. The first that will happen is that once the debt ceiling is resolved, the US Treasury will have to rebuild their Treasury General Account. The Treasury General Account is the checking account the federal government has at the Fed. Right now, it's really low. I think it's below 100 billion. It has a target to either have it at 550 billion by the end of June or 600 billion by the end of September. So once the debt ceiling is raised, the US Treasury is going to issue a lot of debt, and it's going to use the proceeds of that debt to rebuild its checking account at the Fed. When that happens, money will come out of the banking system and into the Treasury General Account. So you can easily see that reserves could drop by, let's say, $400 to $500 billion in a pretty short amount of time. So that'll take us from 3.2 trillion down to 500 billion to 2.7 trillion. Now, what about the other 500 billion that I'm thinking might disappear? Well, as time goes on, I expect the reverse repo facility to gradually increase. And when the reverse repo facility increases, that means money is flowing out of the banking system through the money market funds into the reverse repo facility, which is kind of like a checking account for the money market funds. Now, historically speaking, there's a lag between when rates go up and when people become more interest rate sensitive and move money into money market funds. The lag is usually actually about a year, and we see that happen every rate hike cycle. So the Fed hikes rates, nobody cares, and after, let's say, a year of hikes, people began to realize, hey, maybe I can get more return in a money market fund, and so they move money into a money market fund. Today, money market funds don't have a lot of investment options to place that money that they're getting, so they're choosing to put it in the reverse repo facility. Over the next few months, and we've been seeing this already, we have steady weekly inflows into money market funds of about, let's say, $10–15 billion, which is in line with what we would see historically. As that continues to grow, money will gradually seep out of the banking system and into the reverse repo facility. And in a few months, that could easily be a few $100 billion, especially since money market funds will probably have fewer investment options, as some of the things they've been investing in, federal home loan bank debt, is probably going to decrease in issuance. So eventually, I think we're going to get quite close to the $2.2 trillion in reserves that the banking system needs. Now, I think this drop will be temporary because eventually, let's say in the next several months, the US Treasury will issue more bills, and money market funds will take money out of the reverse repo facility, purchase bills, and then that money then goes into the federal government's checking account at the Fed and gets spent into the economy, let's say to make payments to military contractors or Social Security recipients who then bank with a commercial bank. And so as the Treasury issues more bills, money will flow out of the RRP and into the banking sector. But that's over more of a medium-term period. In the near term, I think there's a very real possibility that reserves could drop to a level where the Fed might be uncomfortable. If that were to happen, the easiest thing for the Fed to do would be the same thing that they did in September of 2019, and that is they would buy Treasury bills. This would add liquidity directly into the banking sector, and from the Fed's perspective, have a really limited impact on financial assets because they're buying short duration assets and financing it with the issuance of reserves, which are also short duration assets. I think if they were to do this, a lot of people would look at this and say, oh, this is QE, and it would be financial market positive. But from a mechanics perspective, I think the Fed wouldn't perceive it that way. Anyway, we'll see how this turns out. This probably won't happen for another, I'd say, 3 months, depending on when the debt ceiling is resolved. Okay, now the last topic we'll talk about is Fed speak. So this week we had some heavy hitters from the Fed talking about their perspective on the markets. We had Chair Powell on Friday, but we also had future Vice Chair Jefferson speak. We also had a voting member, Lori Logan, who was president of the Dallas Fed, speak as well. So she's a voting member, and she made some interesting comments. So I'll briefly note what she mentioned. She strongly suggested that she would be open to hiking rates in June. Her rationale for this is that, well, there's some possibility that inflation expectations may become unanchored. And so the Fed should hike rates to get this problem resolved, to get inflation resolved more quickly. And this is what we mentioned last week and what Bob Elliott has been mentioning as well. So the Fed is telling everyone they're eventually going to get inflation under control, but it's not that easy. There's also a timing aspect to this, because if it takes 5 years to get inflation under control, eventually inflation expectations will begin to rise. We've already had 2 years of inflation above 5%. From the Fed's perspective, they're really worried about inflation expectations becoming unanchored, because if everyone expects that inflation will continue, then they will take that into account when they're asking for wage increases or when they're setting prices. And then at that moment, you could have an inflation spiral, inflation becomes more ingrained, and then the Fed's job becomes much more difficult. Now the question is 2 years of 5% inflation enough to unanchor expectations, or do you need more time? So far, depending on the metric you're looking at, it doesn't seem like it's becoming unanchored. There are some surveys that are a bit more concerning, like the more recent University of Michigan survey. But overall, it seems like it's okay. But there's always the possibility that, if this persists, let's say to 3 years, maybe people should, and I think it would make sense, to expect inflation to be more persistent. So one rationale for hiking rates in June is because we got to get this done sooner rather than later, because there's a time limit on this. So that's Logan's perspective. Now, Jefferson and Chair Powell seem to be a bit more hesitant to telegraph a strong rate hike in June. So what they're saying is that they want to take a look at the data. They're going to be data dependent. Now, Chair Powell made a comment, which he already made earlier, in that because we have some potentially some restraint in the banking sector, maybe we won't be hiking as much as we originally thought. Now, this was already clear from a couple meetings ago, where the Fed, instead of hiking 50 basis points, hiked 25, noting that there was stress in the banking sector. So that's actually not new news. What Jefferson and Chair Powell are saying, though, is that if we have more hot inflation prints, if we have more hot labor market prints between now and June, then we're going to hike again 25 basis points. So far, they haven't made up their mind. So there's a very open discussion happening among FOMC participants, where you have Bowman, which we talked about last week, and Logan in favor of a 25 basis point hike in June, but Powell and everyone else, who are actually more important, on pause unless the data says otherwise. So I don't actually think that the 25 basis points is a big deal or not. What is a big deal is that there's a large difference between what the market is pricing rate cuts later in the year and what the Fed is saying. Chair Powell is resolving that contradiction by saying that, well, this is just the market hedging for different scenarios and perhaps having a different perspective on how quickly inflation will be under control. So we're going to have to carefully watch data in the coming weeks to see if there is enough to warrant another hike. But in any case, it's really unlikely, I think, based upon Chair Powell's commentary, that he would be entertaining anything that would approach a rate cut in the coming months. Okay, so that's all I've prepared for today. Thanks so much for tuning in. If you like what I'm producing, please remember to like and subscribe. And of course, if you're interested in learning more about the markets, check out my courses, some of which are free, at centralbanking101.com. Thanks, and talk to you guys soon.